Three reversal patterns you must know. Today we're going to cover the three patterns, precise entries and exits, common mistakes to avoid, and then we'll go into some advanced details based on experience that you can't learn from a textbook. You can only learn from execution over time, every single day, over a long period of time. So your goal is to know how price reverses so that you can lock profits from your position or profit from the liquidity. I'll explain the two ways that I think about reversals so that you can benefit. Don't forget the 6 components of your trading system. You need all 6 of them to do well. As a reminder, many of you have seen this often. We're going to focus on the strategy. When you're executing your strategy, reversal by itself is not a strategy. It's a component of your strategy. If you're playing a reversal pattern, you still need to have proper risk management in place. You need to know where entries, where exits are going to be, time periods that you're using, candlestick patterns, all these things. We'll talk about the FEF pattern. Those of you in the Academy and the live trading who've done the FEF detailed setup, you won't learn all those details in 5-10 minutes. You have to learn them over a longer period of time, go through all the details, and over time get some experience trading it that will make you better at it. So we're going to cover 3 reversal patterns, the common errors, and advanced entry criteria. Let's start with a warning. Now, there's a very fine line between going against the trend and playing a reversal pattern. I have to keep repeating that. Going against the trend and playing a reversal pattern. Very fine line. And your experience and track record will differentiate this. Your experience will tell you if something is dropping and you keep trying to go against the trend, that's going against the trend. And your track record, if you have many plays where you're trying to play a reversal, but you just keep losing, well, let's focus on going with the trend. And then over time, you can get a little bit more advanced to playing a reversal and knowing where the reversal is. So here's some common thoughts. These are thoughts that you're not playing a reversal, that you're just going against the trend. If you're thinking, oh my God, this has gone up so much, it has to go down now. Or like yesterday, it's dropped so much, it has to go up. If you have those thoughts, you're not playing a reversal. You're just going against the trend with FOMO. If you think, how can this keep dropping? Remember what we said? When things go up, you buy high, you sell higher. This is not retail. When things go down, it's not on discount. That's the price. Short low, cover lower. That's the strategy. I can make it back quickly now. I think it's going to reverse. I can make it back quickly. That thought means you're not trading. And then this must come back to the VWAP. It has to come back to the VWAP. On runaway days, it does not come back to the VWAP. I generally don't use the VWAP much anymore, but maybe with HVH, some of the HVH patterns. But if it comes back to a particular zone, it doesn't have to. So these are ideas and clues that you're not playing a reversal. If you do want to play the reversal, these are the types of ideas you need to have. Something goes up and then you see another lower high. This has reversed. A lower high is an indication that it's starting to come down, at least in the short term. A trend is higher highs, higher lows. And a trend down is lower lows, lower highs. So when something starts to reverse, when you see this and this is a lower high, then you can say in the short term, it started to reverse. Now in the long term, on the 3-minute, 5-minute, 15-minute, 1 hour, and so on, that might not be the case because inside price is very fractal. But this is an indication you're seeing price action. You're not playing your mind how high this can go, but you're seeing a clue that this could start to reverse. You might even say, hey, wave 5, those doing Elliott waves, wave 5 is finishing. ABC is likely to come. How can you measure that? You see wave 1, wave 2 pullback, wave 3, massive run, choppy, commonly choppy wave 4, and you see this exhaustion wave 5, and then you see this drop, and then wave A is starting to build, right? Identifying this pattern would be a good way of saying, oh, I'm going to play a reversal. Maybe you're trying to play this first leg down, ABC, or you wait for the B correction to play the C wave down, to a particular zone that you have in here, that's a clue that you're playing it the right way. Hey, those big candles that are pushing up have low volume. That's weird. That's a clue from the Anna Cooling book, Volume Price Analysis. And this is a great idea that you're thinking, okay, maybe price is starting to reverse. These equal highs will likely get swept. So if you have something that does this, 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 and you're around here, a lot of times when we'll talk about the sweep play today, you might be saying, hey, these equal highs can't be left like that. And you might say a sweep is coming and a potential reversal afterwards. So when you start to notice these things, it's one of the clues that you're playing the reversal properly. Not, I need to make my money back, it can't go up any higher. So contrast the difference between these thoughts. How can this keep dropping? It can't keep dropping. Yeah, look at yesterday, it just kept going. And every time we said a reversal is coming, I even played a reversal and I was up very healthily on that trade. And I was about 3 points away from my target. And looking back in my trade log, I wrote I was being greedy and I had to take it at break even. It went all the way back to my entry because of the momentum on the way down. So notice the difference between these two. Remember, there's a fine line going against the trend and playing a reversal pattern. Make sure you're aware of it. In order to benefit from reversal patterns, there's two things you need to think about. Number one, you're looking for a reversal because you're in a trade and you want to lock profits before the reversal takes place. Let's say I'm in a long, price is going up. I'm looking for clues while holding my trade on why would price reverse around a particular zone based on previous levels I might have, based on the price action here, based on the pattern, based on the volume. If you guys use indicators, based on your indicator, your RSI, Bollinger Bands, the TTM screens, whatever the case is, when you're looking for a reversal, you might be looking for it to exit a long position and lock in profits. That's case one. And then case two is you're not in a trade and price has gone up to a certain level and you believe, based on what you're seeing, and I'm going to explain the three patterns that I use that you should be aware of, that based on the reversal coming, at some point, there's an opportunity to take a trade that goes in the opposite direction after the reversal takes place. And there's a balance between risk and reward. When things are more confirmed, they're more expensive. When things are riskier, they're less expensive. There's that whole balance in trading that will continue to happen. But I need you to think about this on two ways. You're waiting for a reversal because you're in a trade and you want to lock profits before the reversal takes place, or when it gets confirmed, you're out. You don't want to give back too many profits, or you want to wait till the reversal has happened and catch the move to the other side. Sometimes you might be thinking, this move is up, and you're getting in here, and you might be thinking, hey, this is the impulse move, so there's very little to be caught. But sometimes this is the move that goes up, and then you'll see something like this, and actually the move that you thought was the impulse move is only 61% of this entire move that ends up coming down, and you're able to catch the reversals on top and with confidence hold to a particular level. This isn't easy, it's hard, and in many cases I'm working on being able to hold for these entire moves, and it's hard, but nothing in life worth achieving is easy anyway. So hard things are great because you struggle through pain for a very long time, and then when you get them, it's extremely satisfying. So let's move on to the three reversal patterns, and then we'll go through each individually. The three we're going to cover are liquidity sweep, fair value flip, the FVF pattern you guys have heard, and the buy and sell model. I want you to understand that based on these three, they vary between risk and reward. So the liquidity sweep one that I'm going to describe is the riskiest of the group, highly risky. but you get the best price. There's a way to play it, there's a way to see them. These are advanced reversal patterns. I don't recommend you play them until you've studied them a fair bit of time and have the confidence in at least 100 chart patterns that you've analyzed and gone back and said, okay, I'm comfortable, I understand the details around this one enough. I understand exactly where my entry, my exit, and my risk should be. If you can do all those 100 times and then say this pattern works at least 50 out of 100 times, but of the 50 times, I had a 2R at least, that means it's profitable for you. And you have enough of the details to be able to play in. But playing it live is still a lot harder than playing it in replay. But the replay is a necessary background training that you need. You won't shoot free throws well in the middle of a game with adrenaline going unless you've practiced your free throws a lot in the gym by yourself over time. And that's the same way with trading. So liquidity sweep is the riskiest of the three, and it gives you the best price. The lowest price is the best price because it gives you room for profit. Then on the right, we have the buy-sell model. We're going to focus on the buy version. The sell model is the exact reverse. So we're going to call this the buy model. It uses a head and shoulders setup. It's one that I've been introduced. Shout out to Coach Shah, shout out to Philip, shout out to DJ. These guys have really been focusing on these buy models and shared with me what they know that has opened up my eyes, and I see things in a completely different way. And that enables me to be able to bring this to you guys so that you can choose to use it if it works for you. This buy model is amazing. It really helps give you a lot of confirmation, but relative to liquidity sweep and FVF, the risk is lower, which is amazing. And sometimes you pay a higher price, which is the balance that you pay. So which one is best for you? Nobody knows except you. So the goal is to understand and learn all three, go back and backtest, pick the ones you like the best. And like any strategy, any pattern, anything in trading, you have to put it into previous action, test it, and make sure that it works. Number one, we're going to go into the liquidity sweep one. So what is liquidity sweep? So liquidity sweep requires a candle or a wick to sweep and reverse target. So an example is you have price action going up and you get a wick up here to bring it back down. Then you get price action going up and a wick back down. Now we've seen these in trading and many times have said these equal highs, it's common that there's equal highs left at the top, where think about it from a market maker algorithm perspective. If you know as an algorithm or a market maker that there's a lot of retail traders out there who are trying to short this, and you know there's retail traders trying to go long above this level, so they're waiting for this level to go long, and the people who are in short have their stop losses right here because the books tell them that. Short up here, double top. If you're wrong, put your stop loss here. This is common retail mass knowledge. So as an algorithm or a market maker, there's incentive for you to take price. If you can move price around by 10, 15 points, and this is going to go lower, there's a lot of financial incentive for you to move the price up here temporarily. And if you can do one of these, all the shorts are going to stop out. All the longs are going to enter and give you a lot of liquidity in here, for which time you can then move this price down anyway and then continue to push it down. So this is called a sweep. So there's some type of wick or candle, top of a candle, top of a wick, or a price line in here that it's respecting. And this does a little sweep and then starts to push down this way. And it goes the other way. And it's the pattern where if you're playing high of day break or you're playing a breakout, this is the pattern that you get trapped in, because there's quick volume one way and it reverses so fast that you think to yourself, oh, I didn't wait for confirmation. This is why some breakout traders say, wait for the second candle to hold. The second 5-minute candle has to open above, and that they use that for confirmation for this exact sweep, to avoid the sweep taking them in the wrong direction. So the goal is you have to look for the sweep. You have to go back and backtest and know how much does this actually sweep with a wick that goes above. When I was doing it on NQ, the average was somewhere between 3 and 6 points. So you can get away with about a $7 sweep candle on NQ if you're trying to play these. But it varies. Sometimes it might be 10 and it sweeps the other way, but very often it's not more than 6. So if you can give it 7 or 8 on this wick, or place your entry just above here, 1 or 2 points out, you should be able to catch it, have a little bit of room for the reversal. And I'll explain how to play it in a second. But the goal is to understand you're looking for a sweep, the candle, and then you got to find a target where it's going to next. And I'll give you a few different targets. We use fair value gaps. We use the bottom of the last sweep, the volume. Sometimes there's volume imbalances. Sometimes it's just a support line that we think it's going to. And yesterday, as NQ dropped, it dropped all the way down to a previous 1-hour candle and swept the wick. And then in the afternoon, it's swept the next one. Inversion gap is another great one to target. And once there's a sweep, it also creates inversion gaps for you. So here's an example. This is US 30 on the 1 minute. This is the Dow Jones. And you can see that, what do we have here? We have a low, another low, and they're equal lows. And I've been noticing that during the accumulation macros, these are just time periods that there's a theory that there's algorithms running during these time periods when it's not, sometimes when it's got a lot of volume, sometimes there's not that much volume. 110 to 140 is not as much volume as in the morning. And there's some macros that go and kind of move price, and it can tell you whether it's accumulation or expansion. But watch how price action here continued to go down. So you would think, oh, this is looking bearish, it's going to break down. When you see a candle like this, the retail trader would say, oh, this is going down. Anyone who went long in here, in here, in here, in here, any long positions during this range, where do you think they would place their stop loss? Just below here. Look where the books say. Just below this wick. Good eye, Philip. This was yesterday. Yeah, very nice. A lot of these examples you'll see are actually the last few days. I didn't have to go too far for an example. I just want to pick. And some of these, if you're on the right side of the trade, they will be ingrained in your mind. And if you're on the wrong side of the trade, it will be ingrained in your mind forever. But this was Dow Jones, and it was accumulating, and it was coming down. And then look at this wick. It dropped just below here. And Dow Jones trades at a larger number, around 40K. So these movements, it's easy to see a 10-point candle, 20-point candle. Here you can see about a 20-point candle. This one's almost 25 points. But the range is irrelevant. I kept it in there so you guys can see which ticker it is. But these candles are fractal. You'll see the same patterns on NQ, on ES, on Tesla. You just need to notice them. Like a new car that you're deciding to buy, you think you want to get the next Tesla. And once you make a decision, start to see it online a few times, you will start to notice them everywhere when you're driving. Same thing. Where you put your attention, you'll see more of that. So these two wicks created an equal low. And this is one of the patterns that I played. I even played one on NQ yesterday. I think it might be here as an example, where it swept the bottom, and you would place your entry here like a market maker, a buy here. Now, the thing is, you don't have as much liquidity as a market maker is. So you have to be very careful, and you have to study to decide where is the appropriate place to put a stop loss. Because this is risky, because you're going completely against the trend, expecting a sweep to happen and planning an entry here. and an exit in case you're wrong and it dumps. This is the most important, crucial part. How do you plan your exit? How much are you going to give it in the situation you're wrong? In the situation where you place it just below here and have a stop loss at 720 or 715, depending on how much you want to give it. Usually 10 to 15 points is reasonable for US 30. More than that, you're really changing your risk and reward. And then what did price action do? Swept up and then targeted the other end. So this sweep is what these guys do to get people out and to entice whoever's long, get out of your position. Whoever's short, here's the breakout. Here's the breakout, short it. And then they'll flip it the other way. And now that you're aware of this pattern and the way the sweep happens, you can keep an eye out for it and notice as things happen. Very often I've been noticing when there's 1, 2, 3 equal lows and price action is kind of meandering, I'm expecting a sweep before the push up. So if I believe it's a long, I'm going to wait for that sweep. And when you get a sweep followed by a pretty big, nice candle that creates a fair value gap in here, we'll talk about the FEF pattern in a second, but when you get a sweep and you get a fair value gap, look at this drop perfectly into the fair value gap for the distribution back up. It's a hint into reversal pattern number 2 in a little while. Here's another example. Liquidity sweep example B. This is also US 30. Price action is going down right here, 695. Price action gets swept and immediately pushed up. To get a liquidity sweep, you don't need to always have 2 equal lows or 3 equal lows or a lot of them. A lot of times it's just sweeping a particular price at a particular level and reversing the other way. And then it completely reversed the other way. And if I remember correctly, I think this price level gets swept at the end also. It ends up being in here for a little while and then ends up pushing up and sweeps that level too. So the beautiful yet very risky, I have to keep reminding you, this is super risky. And so you have to develop your style. There's some traders who are out there who just play reversals, they love them. And there's some traders who only go with the trend because they find this too risky. And you have to understand, it is risky and it also gives you an excellent price. And whether it works for you or not is only dependent on your trade log and whether it can help make you money. But if this was the low and you look for that sweep, you would put a buy order just below here where it gets swept, and you would put your stop loss. Let's say in US, you give it 10 points down here. So as price action came down, you would get filled and it goes up. The way I play these is if I get my sweep that goes the other way, I immediately take my stop loss to break even. So I'm in a free trade. This helps me cover the losses for the times it may not work. And when you move it in immediately, it's a very nice feeling that you're in here. You have built up a little bit of cushion of profit. You can start to focus, where am I going to target this liquidity here, this liquidity, wherever your next target is. Maybe you have an order block that you're trying to target that's up here before the drop. Maybe there's a little fair value gap, a bearish one in here that you're trying to target. Many ways to find your target, but the beautiful part is your entry is almost perfect with precision because you've studied this liquidity sweep over and over again. And you've had many examples that have told you where to place it and how to place your stop loss. All right, here's example C on NQ. This is the one I played a couple days ago. I think this was Wednesday, maybe Thursday. This one I actually played. Accumulation macro was here in the morning, started to go up, peaked up here, and then I saw a little bit of a drop. And I expected this liquidity to be taken out, and then it reversed back down. And right here, I had a sell order right here with a small stop. I think it was like a 5 or 7 point stop around here. And so that was my entry for the short, playing this sweep pattern downwards. And then this was a nice feeling. And this was where I locked in profit at the 50% marker of this macro. So I took a sweep from here, very low risk about 5 to 7 points. And as soon as I saw this red candle and this started dropping, I just moved my stop loss to break even. No big deal. And this started to go down and I took profits here. Was it the best place to take profits? It actually went down and tagged down here. But for this time, I took profits here and then I watched it go down and I thought to myself, this is another target. It targets the bottom of this time frame also. There was liquidity here. This wasn't too hard of a hold at all. The harder holds are the ones that do something like this, like a multiple leg correction. This was actually a pretty easy hold. So in my trade log, after I took this one, it was a nice green trade. This is what I really like, getting 22 points, 24 points on NQ, or I think maybe I got a little bit less, 22 points. I remember getting on this 22 points, risking 5 is a 4-to-1. But I could have had more. I could have had 48. I could have had almost a 10R on this trade, which would have been great. But it's available and it's in my trade log, and I'm not saying you can get them all the time, but I caught the 4R and there was almost a 10R available for me that day. And this is how you should track them in your trade log. So why not, when you're entering, move your stop loss to break even and you have your 4R, you wait for a green candle to take you up, and then instead of exiting, which I did, I could have also taken my stop loss, which was now at break even, and moved it above here or above this green candle as a stop profit, and then waited to see if I would hit my next target. Maybe this, maybe this. I think it tagged at the same level. There's a chance if I had my exit here, there's a chance I may not have been filled before this reversal. And it moves pretty quickly, so you have to be careful. You guys know I like moving my profit levels just inside these targets for this exact reason. But the point is, here's the sweep. Know where your stop loss needs to be. And in the case where this keeps going, and remember, when you're going against the trend, you have to be able to assess these candles because it can so easily just take off. And one of the worst feelings is if you short here and you put your stop here, and your stop is 5 points or 6 points, maybe 7 points, and the wick goes right through, stops you out, and then reverses in your direction. That feeling is one of the worst feelings in trading, where you were right, but your stop loss was in the wrong place. And for that time, it may have been in the right place for your strategy, but it was in the wrong place to play it that day. And the hard part is, beginner traders think that it's their fault they do that. They accept the blame, and then they start to overtrade or chase or get back in, and the emotional trading comes into play. I know, because I feel it sometimes also. But the right way is to say, this sweep was not within my range of 5 to 7 points, and the stop out was the right call. I'm not going to enter this trade again. If you want to enter for a fair value gap later for a different reason, that's okay. But I don't recommend chasing, and it's one of the common problems trying to play these sweeps. What are common mistakes here? Playing the liquidity sweep, one of the biggest common mistakes is too large a stop loss. You give it too much room. A sweep is a sweep. A sweep should not be moving 15 points on NQ. It shouldn't be moving 5-7 points on ES. Tesla shouldn't move 50 cents a dollar on a sweep. A sweep is small. So when you target a wick here, a wick here, a wick here, and you want to short above here, your stop loss cannot be big. It needs to be small. And you need to figure out what that balance is. I'm finding 5 to 7 on NQ. Go back and study these, and you will find the number that works for you comfortably. Too big means too big a stop loss. That's not what you want, because you're going to take big losses. And then if you take 3 big losses, that's where the average trader will say this strategy doesn't work. A lot of them do it at two trades, both red. I don't like the strategy. Let's move on to something else. Not enough time to become. Just think about, you want to be excellent at free throws, and someone says you should practice your free throws this way, put your arm like this, bend your knees, and you take 2 shots in the gym, you bending your knees and putting your arm like they described, and you miss both shots, and you say, no, their strategy doesn't work. It sounds silly, but it's what a lot of people do. Number two here, not moving your stop to break even. So when you get a sweep, equal high, when you get a sweep here and you're into the trade and it starts to go your direction, remember, sometimes it's against the trend, and it's very good habit to move your stop loss to break even. So your worst case scenario, it's just a pullback and it blows right through. You just missed a free trade. It's just a free trade. It didn't cost you anything. You have no loss. But those of you who might leave your stop higher and you wait, and then it goes and it stops you out, it might entice you to take more trades, and then you have bigger losses to account for, and then you try and chase, and it leads you down that path that nobody likes. So move it to break even, and then at least you can be comfortable. This is a strategy I use to help me hold longer, where I just repeat to myself, no big deal, break even trade, and then I can hold outside of my comfort level. And then last one here is taking too many attempts of a liquidity sweep. If you believe it's going to sweep and it does this and it keeps going and you stop out, I don't recommend trying to take the same sweep over and over again. Sometimes it goes down, stops you out, comes back in, and you're just in a choppy area. And then you're thinking, okay, well, here's another one, I'm going to play this one, and it stops you out. 1 or 2, ideally walk away for an hour so that you're not over trading. But if you're taking too many attempts, that's a clue that you're not finding the right areas for liquidity sweep, or it didn't work that day. And to be able to study the strategy, go back and see what could you have seen differently. Maybe the time period that you were doing this was between 12:30 and 1. Very common time period for it to be super choppy. So that's not the ideal time to play. A lot of these breakouts that I described happen at particular times. This one was a sweep that happened at 10:20 to between 10:10 and 10:20. So look at the time period to see whether you should be taking more attempts at that liquidity sweep. We're going to cover what's called a fair value flip. Those of you in live or the academy, there's a specific course on this that is about, I think, 45 minutes long, in depth. That's the next level of detail that you need to know with step-by-step instructions. Today, we're going to cover the surface level and some examples so you at least know what the concept is. And then if you're interested in learning more, just message Jessica. So the fair value flip requires a sweep of a level. There's 3 things we're looking for. Sweep of a level. I'm going to change my color. Sweep of a level. You must have a level in play. Then a clear reversal drop. I'm going to do the bullish scenario. And then you're looking for a fair value gap entry. So it's important that you have some sort of line in the past that you're looking. It could be a previous day high. Twitter model sometimes uses the midnight open. Sometimes it just might be a swing high or a swing low from a previous day or earlier in the day. Sometimes we use the Asia session or the London session high. But there's an important level that we're looking for. That's number 1. Number 2 is price action starts to go up and it has to be a sweep. What signals a sweep? A sweep is price action goes above it as if it's trying to capture the longs. We've been talking about sweeps for a few months now. It's trying to get the longs to go long. And it's also trying to get the shorts who might have shorted in this region thinking, oh, I think price action is going to go down. But if price action goes over this line, then I'm wrong. So they're going to place their stops here. A stop of a short is a buy. And the folks who want to go long are also a buy. So there's a lot of buying here. So the sweep means when price action comes here and it starts to go up, it fakes everyone in, fakes the shorts out, and then quickly sweeps down. This feeling of a sweep is that feeling that you used to have, and I know you've had it because I've had it many times, a little bit more in the earlier part of my career, where you just get in because you think you got a trade and you're slightly green and boom, you're red really quickly. And if you didn't have your stop loss in place, it could put you in a territory that's no good. But this sweep, what we're looking for is to come down and show strength in the other direction. You still can't get in. And one of the signals that this is a sweep and is creating good strength is on the way down, it creates a fair value gap. Now, the beautiful thing about this fair value gap is it gives you a zone to enter. So with this fair value flip entry criteria, it starts to go back up. When price comes up, this is where you enter in this zone. There's a 50% area. Sometimes it wicks above and stays in and then continues to go down. But ideally around 50% is where you enter with a stop loss above the previous high. And then you take the move down. So the things you got to keep in mind when you're looking at the fair value flip, it might sound a little bit complicated, but it isn't. It might look a little bit complicated, but it isn't. Remember, it's the sweep level. We want to create a fair value gap on the way down, and we want to use this fair value gap for entry. Now, as you get more sophisticated, you'll be able to do things like see how price action reacts around this PD array. You might be able to look for closes above or below. You might be able to match with some other shoulders. Those are more advanced techniques that you learn over time. But for now, the fair value flip is looking for that fair value gap in here. And then sometimes this sweep is so aggressive that it creates multiple fair value gaps. And the first one is left unfilled. And you have to capture the second one to get in the move. How will you know which case it is? You don't know before it happens, but you can get an estimate based on this move on your back testing when it comes back to the first one, when it comes back to the second one. So let's do some examples here. Actually, let's do the 7 steps first. First, mark the highs and the lows of previous day, of Asia session, London session, and you'll have a bunch of these lines that you're looking to capture. Then look for that liquidity sweep. That liquidity sweep should create a fair value gap. If there's no fair value gap, it's not a true sweep. It's not forceful enough in the opposite direction. You go back to marking your highs and lows and looking for another liquidity sweep. But if it is, and you do get a fair value gap, then you must calculate your risk and reward and sizing. Where can I get to? Where do I enter? Where's my stop loss? If you're looking for a 1-to-1, no good. Let it go. It's not worth it. You need to be right at least 60-70% to make any reasonable money. But if you can get a 2-to-1, 3-to-1, or even 4 or 5-to-1 bonus, then consider taking the trade. Look for an entry in the fair value gap, place your stops and your targets, and then manage the trade accordingly. The way I like to manage trades are when it starts to move in my direction sufficiently, or I get another lower low, then I like to move my stop to break even. And it's a free trade. And I've evolved over the last couple of years to look for more free trades and just let them do their thing. It's helping me hold longer, and it's helping me take additional trades that don't cost anything. And if I take a trade and I get stopped out, I take another trade and I get stopped out, it's not even letting me bring my stop to break even. I know my trading is off that day and I can stop trading. The market is not moving in how I expect it to. My entries are off, my psychology's off, something's off, but it's clear that it isn't working, and I know based on that I need to stop trading for the day. But if I take 3 trades and they're all moving in my direction and I move my stop loss to break even and I'm hoping for a 3R or a 4R, so I'm waiting to see what the market gives me and it stops me at break even, no problem. It's a free trade. There was no cost of being in that trade, and I learned something. Maybe I was being a little bit greedy, or maybe I'm just aiming for bigger R returns. And in order to do that, I need to sit there and be patient and wait longer. And that's fine. Either way is fine. Let's go through some examples. This is the best way to show it. So here's NQ on the 1 minute. These are all charts from last week. If you want to go back and study them, they're probably Tuesday, Wednesday, Thursday, last week type of charts. So price action is starting to go up here. We're starting to move. It's moving up. So clearly we're in an uptrend on the short time frame. Now, ideally you'd have a level around 740, 741, 742 that it's trying to sweep. But when this starts to come down here, here's an example. Went over this level, started to come right back down and created a fair value gap in here. Then price action started to come down and it broke this last low. Here's a market structure shift on the short time frame. This is a better market structure shift. There's a little gap in here as well, but this is a very close short-term market structure shift that was broken when this happened. Then price action went above into this fair value gap, started to reject here, rejected another time, it started to come back down. After that, stock started to drop. So this is not a super clean, perfect version. And ideally, a few things I would want more is, this is the major market structure shift and this is the minor one. Minor one was broken. Price action came back into here, rejected a couple times, and then gave the move back down. So your entry would be somewhere around here. Your stop loss would be above the high of day, wherever this last sweep was. And then your profit targets could be any of these. If you enter in here, you could use this liquidity sweep or this liquidity sweep. I think price action got down to this one as well, but it's all depending on your ratio. If this is your risk, then your reward could be, this is 2 times, 3 times, this would be a 4R. Here's another example. Price action is down, came back up, holding here. Let's see what happens, goes back down, and it's swept below these lows. So you would have created a previous low here, and you would see price action go below. Now price action can continue right now, so right now there's no entry. And then this is an aggressive candle going back up. And then it continues to go back up. And what you'll find is initially when price action starts to go up, there's a really tiny fair value gap in here. If you spotted that, that would be an area that you could enter. But the problem is the market structure hasn't shifted yet. So what you want to see is once it creates a higher high, price action starts to go up, there's actually another one in here. There's a fair value gap in here. That could be your entry. So if you're watching these reversals happen and you see a fair value gap and it quickly gets in and continues to go, and you're not in, you want to play FEF, let it go. Often there will be another one that comes into play. And you can start to look, especially if this is a true FEF that you're catching a reversal pattern, you would expect price action to do something like this going forward. And if you don't catch this first one, you can look for support on the second one, potentially the third one. The earlier, the better, but you also want that confirmation to play. And then this price action started moving back up really nicely. So the details are here. We're looking for a sweep of the bottom and then aggressive price action up. I like this aggressive price action up because it shows an immediate reversal. And when I see an immediate reversal, it makes me think if I was shorting here or I was long around here, I didn't take profits, started to come down, I would have been out break even probably. But some people like to give their stop loss and say, well, it can come down. As long as it's below here, I'll get out, and they'll place their stops below here. They would have been trapped on this and gotten out, and then it quickly reverses, and that's what creates the FOMO for someone who's long goes down, gets stopped out, and then it quickly reverses. They want to get back in. That helps create this momentum. Retail traders who do that, but mainly it's the price action of the reversal that's causing it to go back up. For those advanced traders on live, here's an imbalance as well. I love to spot these imbalances, and they're nice. They place similar to fair value gaps, an area of support that you can watch, and if it holds, price action holds here, it can give you big moves back up. Third example here, price action down. I don't remember what's on this chart, so what I would have done is this so far, and maybe this one, but it's probably going to sweep the top. Let's see. Yep. So price action goes up, sweeps the top. So right now it's long. Right now I'm not thinking about the short, but I'm saying, well, I would need to see some type of sweep for price action to come down for me to enter. And here, this aggressive push down, this is where most traders say, I've missed the trade. I've missed the short. Oh, this was double top and it came down. I missed it. I don't want to chase. Patient traders playing FVF love this setup because they say, look, I have two things so far. This was my previous level. I have a push over that previous level, that sweep, and I have an aggressive pull down, which gives me this clear fair value gap. So now that I have this clear fair value gap, I haven't missed anything. I'm waiting for this fair value gap. Price action's down here. It's showing me it's bearish, super bearish from this down move. 8 points really quickly on ES is pretty big. And so I'll wait. Oh, buy candle. I like this. Now, this is where someone would get scared to play FVF. Completely understand it. Big buy candle in here. But if you're playing the FVF pattern, you mentally have to say, I'm going to enter around here. My stop loss is just above here, and I'm totally fine to risk, what is this? 44 to 48, 3.5 to 4 points. If you're comfortable doing that, that would be 4 points is like $200 per futures contract. You have to be okay with that, and that's the setup that you take. Price action comes back in, gives you two opportunities to enter, and it's doing two things in here that are very nice. If you can see the details, and this is why studying matters, price action came in and it rejected once, and it rejected a second time, and it closed in here. Now, I don't know if this will drop or come up a little bit more, but it's doing the things that I like to do in here. So I would be fine to enter in around here and have a stop loss here just in case it goes a little bit higher. And what happens next? Went a little bit higher. Now, price action closed just above here. It wicked and closed just near the top and then started to reverse here. And then it came right back down. So depending on your risk and reward, one of your targets could be this liquidity sweep. And if you go back on the chart, you'll probably find something around here that you can aim for where the second drop ended up hitting. So I can't tell you which level does it hit every time because it hits different levels each time. And sometimes different things happen in the market that cause it to bounce off this level or the next level. But your chart time will give you experience and make you more confident about the different levels that you have. But the way I like to play these are, if I get a drop, and then I get a push up, and then this drop starts to continue, this is an official lower low. I have this high, sorry, lower high. This is a high, lower high that I entered, I was in, I got a green candle, and then as it starts to drop here, this is where I take my stop loss and move it to break even. Because if I'm right, it should hit one of my targets before it comes back and breaks this last high. So now, these are common mistakes. If the rejection isn't strong enough, if you don't get that sweet candle down, if you don't get this, that creates a nice fair value gap, It's not good enough. You're forcing it. So how will you know when you're forcing it versus good enough? Backtest over and over again, and you'll see the bigger ones are better. Those sweet candles that push down strongly and create a nice fair value gap, those are the best ones to enter in. Impatience for entry. Don't force the entry. If it starts to come down and creates a few fair value gaps on the way down, you should be excited. Don't feel that you've missed it. Wait for price action to come up and be patient and wait for it to enter. I've made that mistake a couple months ago. I remember 2 times. I waited for the wrong fair value gap, the second one, and I wasn't patient, and I entered in there, and then it went up to the top one. And it taught me a few valuable lessons that of my patience and my need to be able to wait a little bit longer. Taking too many attempts, forcing it, if it stops you out, no problem. But if you're taking the same trade over and over again in the same setup, that's a mistake. Now you're chasing it, now you're forcing it. You're not letting the move occur and you become a part of the move. Participate. You should think about yourself as participating rather than forcing this move to happen your way. And then shorten your targets if you're going against the trend. This is a common mistake. We're uptrending, we sweep something, you get in here, and then you want to target down here. Well, the only way this is going to happen is if you're probably on the continuation move. But if you're not, you're going to need to shorten your target to one of these liquidity areas that has been swept recently. So if you don't shorten your targets and at least move stop losses in and mitigate risk, then it's going to be a situation where you're playing FVF well, but you're not planning your targets properly. Last one here, let's cover the buy-sell model. Shout out to Philip, DJ, who've been sharing this with me. They taught me how this works, and it's opened my eyes to the next level on how these patterns show up, and I love to play them now. So thank you for that. And now we're sharing this knowledge with you after an experience of trading these for some time. And now you're going to start to trade these patterns. You're going to become better and customize it to your style. And then you're going to pass it on to someone else and make someone else more increase their skill set so they can observe these in the market and make money from them. The buy model here is you want to identify a head and shoulder pattern. Your head breaks the neck and sets up for a right shoulder entry. What does that mean? Well, that's why we have diagrams. Looks like something like this. This is a buy model, so the head and shoulders pattern is to the downside. This is a head and shoulders pattern. Makes the left shoulder, makes the head breaks this side, and the key is this right side of the head breaks over this neck of the shoulder. This is the market structure shift that FVF is telling us about. There's a little overlap between FVF and this pattern. But I want to see this market structure shift come up, right side breaks, and then in here, you're trying to look for a safe entry, a fair value gap. Maybe your fair value gap was here. Maybe you have an imbalance. Maybe you're lining up with this shoulder. Maybe you have support underneath like this, and it's broken into a 1 hour fair value gap and now supporting this fair value gap when you're looking to enter. It could be many things, but there's support around here that you're looking to take. And it's the head and shoulder pattern that you're trying to enter on the right side of the shoulder. And for additional confirmation, sometimes let it bounce, let it go, and then you buy this first fair value gap pullback before it takes off. So here's some examples. NQ is moving down on the 1 minute, moving down, and then it starts to come back up. So I see this shoulder, head, and now I'm looking for some type of pullback to enter. So in here, you'll be able to see a couple things. When price action comes all the way up here, it's now swept this high. So this was the previous neck. This is now broken. So now I'm waiting for price action to come down and I have a few different arrays that price action could start to come into. That's one of the fair value gaps I see. Here's another fair value gap I see. Here's a little one that just came in. And based on that, you have to wait and see. Sometimes it doesn't come down to this one. Often it will come just to this one, but sometimes it will go one leg lower. So here's an idea for entry. Here's one area that you can start to look for, and you could consider an entry here with a stop loss. This would be a pretty big stop loss for me. Or you could put a stop loss underneath this one, or you can have a tighter one below here, depending on your risk and reward and where it's going to go. Now, a lot of times pullbacks are ABC patterns, So whenever I see something like 3 candles down like this, I always feel like there's like one more sweep coming from here. I haven't seen these charts in a week, but yeah, this is, and I think it's instilled in my mind because I actually played this one. That's why. Fair value gap in here. Fair value gap in here. And there's a second sweep in here. So remember, we have our left shoulder, our right head here, and then this is the shoulder that's developing. And there's multiple fair value gaps showing the strength. And then here's the model where it bounces right off here. And it does the ABC pattern, and it does the C to sweep the bottom of the A, pulls it, and then just takes off like a rocket. And I remember this because I took this trade and I had to study it afterwards. And I remember that this fair value gap didn't get filled. Let's go through another example here. If you're finding this a little bit complicated, don't worry, it is complicated and it takes some time to absorb. There's easier reversal patterns and there's more complex reversal patterns. And as you master the easier ones, then you'll advance to the more complicated ones, and then you'll start to see those with simplicity. And then the ones that are most complicated, you'll start to see them and say, those are so easy. And this is the evolution of becoming better at anything you do in life. Here's another example. Here's that last sweep in here. Now, if you see, there's a very small fair value gap. I don't see one actually. Little one in here. I wouldn't say that's an aggressive push. There's a little one here. I think that's all I see actually. There's a tiny one in here, but I wouldn't really count that as a fair value gap. There's a small one in here that I wouldn't really care for. Is that the one that ended up? Yeah. So this is the one that actually got hit. Little fair value gap in here. It got hit very quickly and took off. So sometimes you'll see a pattern that hits this. It's like a shoulder, head breaks this neck and has a pullback and takes off. And there is no great fair value gap to enter. And you could be forcing it in this area, but just be okay with some examples just won't suit what you're looking for. And this is not a great example to take. It's a good example to show you that it's something that you should observe. Now, every pattern isn't perfect. And if I'm in something like this with lots of wicks and I can't see my fair value gap, and I also would like to see a more aggressive green candle giving me some space to enter. And so this is less of a confirmed entry for something to go up, and something that I would probably skip unless I was trying to force an entry here. That's probably the only one that I see. Now let's go last example here. This one looks good. What do we get? A sweep down here. So here I see shoulder, head. Now I need this to come up above in order for me to consider this a buy model here. There's the break. Now the head has broken over this level and it's created a fair value gap here and not really anything down here. So this is the only entry I see so far. Ideally, I would want to wait to see price action get back into here and see how it responds. There, it dropped. This candle itself is nice because it's a good drop, and it holds this entire, it wicks below and holds and closes above here. So if I see this next green candle hold, I might even consider a long above here or here halfway through this candle. And there's the hold. So it's a tight entry. These are on the 1 minute, but remember this is fractal. It'll apply to the 3 minute, the 5 minute, and so on. And as this bounces out of this range, that's where you get to take off. So no, I didn't pick the bottom. No, I didn't try 1 time, 2 times, 3 times, 4 times, 5 times, hoping I got the bottom. I waited till the bottom appeared to be in, because I don't know at this time if it's the bottom. I waited for a structure shift above, and then I took a nice entry into a fair value gap. Now, the only way to play these well is to go back and back test how many times on the downside did you see a setup like this that you actually entered in on this fair value gap with reasonable risk at the bottom of here, or the last swing low, or super tight would be underneath here, which gives you excellent risk and reward, but it is super tight and you have to be very precise with your entries, but it helps you get in on these takeoff rocket moves that continue to take it up real quick. And you get paid really fast, and you get the option to bring your stop loss into break even really quickly. So common mistakes here, you're not waiting long enough for the entry. You have to be patient for these. Wait to be very selective on the market structure shift and the pullback into the fair value gap that you take. The other common mistake, and when I was learning to do this and applying it, I was entering too early on the right shoulder. Wait for one additional confirmation, one additional. It's always will pay off in the long run if you wait for just one additional one and start to find that fine balance between patiently waiting for it to happen and coming right back. And then the last common mistake is, hey, I learned something new on a webinar with James. Let me go trade it today. Don't do that. Learn what you learned today. If you are getting excited, if you have that feeling inside that I'm getting excited, I'm learning something new, this is cool. He uses it very often. Other people use it. I can learn from this and become better. Great. Your next step is not to trade today. Your next step is to go back test it. And that back testing is going to give you the details and the confidence. Because if you take this today improperly 2 times and you stop out on both, you will not trade this again because you haven't tested it enough. But if you go back test it and you make 2 mistakes and you say, oh, that didn't work here, but wait, out of these 50 runs, it worked 30 times. That's 60% it's working. It's giving me a good risk and reward. But if I wait for this shift first, then it's going to work 75% of the time. Then you've done the due diligence that gives you the confidence to stay in the trade and see the right setup when you see it. I highly recommend doing that.